How's it going? It's Andy. I desperately need a haircut, so that's the reason for this today. So be sure to let me know in the comments down below how much you hate it and how unprofessional it looks. Today we're going to be giving an update on my $6,000 dividend portfolio. I made a video about it a couple months ago and it was pretty well received, so I wanted to give an update on it, talk about how much I'm bringing in annually with dividends, the yield that I'm getting from that, and talk about 3 dividend stocks that I'm going to be buying for the upcoming weeks and months. We're at a really interesting part in the stock market where things have been down for the past year, but we've seen a lot of recovery in the past couple months. And if that continues, that's fantastic. But if it goes down, we're gonna have some buying opportunities that we haven't had for a couple of months. So I'm gonna break down my portfolio, talk about the stuff that's done well, and talk about the really exciting thing that's happened recently that was kind of surprising to me. So the first thing that we want to get out of the way is that I am positive on my portfolio. Woo, we finally did it. Fantastic. So I'm up 1.87%. Well, right now, QQQ, which is the NASDAQ, is down 9% in the past year, and the S&P 500 is down 8.5% during that time. So how am I beating the market by so much? It's the power of dollar cost averaging. This is one of the huge parts of investing that I think that people overlook. I was talking with my partner recently who is very set on trying to buy at the bottom and getting the best price, because if you think that the stock price is going to go down, why wouldn't you wait for a couple weeks to wait for a better price? Because then when it does go up, you're going to make more money. And the worry is that it's never going to go down. So if you're waiting to buy in and the stock price never falls, you're not going to be buying in. And it's so much more emotionally difficult to decide when to buy in if you're having all these criteria of, is it low enough? We'll see what happens. So dollar cost averaging is the idea of buying into stocks on a regular basis, regardless of price and how it's done in the past X amount of days. So I just bought in, I think I bought like 80 times over the course of the past year, and I do not care what the price of the stock is. I just bought it no matter what. And that means that I was buying at lower and lower prices as the stock price fell, which means that I did not have to get back to the S&P 500 or the NASDAQ being in the green for the past year to be positive. So this is one of the huge positives of using dollar cost averaging or the dividend snowball to invest, because as these dividends are coming into my portfolio, I'm just snatching them up and then they're getting reinvested back into those same stocks. So when we put up the portfolio right now I have around an 80-20 split between individual stocks and ETFs. So we'll talk about each stock. And the interesting part is that now we have stocks that are green and we have some stocks that are still red on the year. And that brings you to an interesting decision of, do I want to buy the stocks that are down? Because if I look at my portfolio and everything is weighted evenly, and I feel the same way about every stock, it wouldn't make sense to buy the stocks that are at a discount, right? We'll talk about at the end of the video of which stocks I'm looking to buy. But the largest parts of my portfolio, the largest member is Microsoft, which is up 1.74%. This is 16.3% of my portfolio. You can have the perfect portfolio based off of what you see with percentages of your account going into individual stocks. I don't really worry about that too much. I just kind of buy whatever sounds good at that given date. And that just means that Microsoft was my highest performing stock. Even though it's not a high dividend paying stock, it's a stock that's going to do incredibly well if the stock price and the market goes up. So that's why it's kind of there. The next one is probably my favorite dividend stock. I guess the next two are my favorite dividend stocks with Abbvie and PepsiCo, which are both up 4.5% and 7.5% overall, and they make up 13 and 12% of my portfolio. These are just high dividend stocks that are incredibly reliable, and I just buy them so frequently that that's why they make up such a large portion. Then you have Nextera Energy, which is a great dividend stock, Apple, Realty Income, Nike, Johnson & Johnson, Home Depot, Procter & Gamble, and then the two at the bottom, PayPal and BlackRock. I think BlackRock is 46 cents. I thought I tried to sell all of it. Apparently that didn't happen. Those two at the bottom don't really matter. And then we'll go over to the ETFs, which are 20%, and that is 16% in QQQ and 4.4% in QYLD, which is a covered call ETF that does well when volatility is a lot higher in the market. So as the stock price of the market has continued to go up, the yield has gone down. At one point, I think I was getting like 13% on an annualized basis, and it pays out monthly, so I was just buying more and more. It has really fallen behind. I might sell out of that position now. The volatility has kind of gone down a little bit. It was kind of a hedge to see how the market was going to do. But QQQ is one of these positions where when I look at my partner and I ask what do they want to buy, I just tell them to buy QQQ because it follows the overall market and it's just so reliable, and the NASDAQ and the tech stocks have been the best place to invest for the past decade. And that might not change, it might change, but I think it's just a reliable place to invest. And that's why I kind of have my 80-20 split. You can buy into dividend stocks because I like how it pays it out on a regular basis, but it's kind of spread out across the calendar. So I'm getting dividends from here, getting dividends from over there. And it's not just 4 times a year. It kind of spreads it out, which I think psychology-wise, kind of a little bit more beneficial for me. So now let's talk about the thing that everyone's waiting for. How much money do I expect to bring in with dividends, and what is that yield going to be? So drum roll, it's going to be allegedly $151.23 for 2023, with an average monthly investment income of $12.60. And before you ask, this is on Charles Schwab. That's where I get these graphics from, which is the broker that I use for my dividend portfolio. It's fantastic. And so when you see this graph, you'll see that a lot of the dividends are kind of loaded into 4 months. A lot of dividends pay out quarterly, so that's why you're going to see spikes when a lot of them kind of overlap. So March, June, September, and December are going to be the months that I'm going to get the most. But on average, I'm bringing in $12.60, which doesn't sound like a lot, but it's the idea of this is money that I wasn't going to reinvest beforehand, and it's just getting put back into the portfolio, which is the idea of the dividend snowball, that those dividends are being reinvested back into the stock market, which will allow, if we could see 2024, it would be higher than this because $151 is going back into the portfolio and is going to go back into dividend stocks. Right now, the dividend yield, $151.23 based off of a $6,000 portfolio, is a yield of 2.5%, which I'm actually really surprised is that high because my highest weighted stock is Microsoft, which is not a high dividend paying stock. It's more there for the growth potential, even though it does pay out a pretty small position. Same with QQQ and Apple. These are not high dividend paying stocks. So I'm pretty impressed that my dividend yield is still sitting around 2% or 2.5%, which is around the level that I'm looking for. It is a healthy yield. It's not something where the rules that I have set in place, which we'll talk about in a little bit, if the dividend yield is too high, I get pretty worried. Around 4.5%, 4%, I start getting worried. So 2.5%, I am happy with that dividend yield. You can get much higher, and let me know down below what your dividend yield that you're shooting for is in the comment section down below. Let's talk about the stocks that I'm picking for the next couple of months, because I have not talked about individual stocks and how I buy them for like a year at this point. So when you're looking at the overall market, when everything is down, you can kind of just pick which ones you want. It's a little bit more difficult now when I look at my portfolio, and some of my positions that are higher weighted are up because when they're higher weighted, they're going to go up more. And so there's a large discrepancy between my highest performing stocks and some of the lower ones. And so we're going to talk about the 3 stocks that I'm going to be buying for the upcoming months on a variety of reasons. There are the 4 criteria that I have for buying stocks, which stays the same no matter what, which is a dividend yield below 4.5%. We talked about this already. I don't want to buy into a stock that is heavily reliant on the dividend yield as being an attractive investment. So below that, while having a strong performance is what I'm looking for. It has to have beaten the S&P 500 since at least 2000. I picked 2000 because it shows a variety of market conditions. We've seen the dot-com bubble, you have the financial crisis, you have the pandemic results, you have the period of high inflation that we're seeing right now, and showing that the stocks can outperform the S&P 500 during that time makes me feel a lot more confident because I've seen how they've done in tough times. It wouldn't make sense to buy into a stock that has underperformed the overall market for the past 25 years. You might as well just buy the overall market. So that's one of the things I'm looking for there. Number 3, it has to be a dividend aristocrat or better. This means that it has raised its dividend payout, not the yield, just the payout for at least 25 years. And it kind of goes along with the outperforming the S&P 500 discussion, is that I want a stock that has shown that it can pay out its dividend reliably, because if I'm buying into a dividend stock, I want the dividend health to be reliable. And that's what I see is the thing that people always say is that past results do not imply future results. But seeing that makes you feel a lot more confident than a stock that's brand new and has not paid out a dividend for very long. I want to see how it's done during different market conditions. And then finally, you have to dollar cost average in the position over time. We're not trying to time the bottom. This doesn't have to do with picking individual stocks, but it's just kind of the overall investing process that I go through. Is that I'm not trying to pick the bottom, I'm just going to buy in consistently. But over the past year, I've had some stocks fall behind, and that's why we're going to talk about the 3 dividend stocks that I'm buying for the upcoming months, and let me know which dividend stocks you are buying in the future down below. So the first one I wanted to talk about is Nextera Energy, ticker symbol NEE. This is a position that I'm still down on currently, down 5.7% on the year. So this is a stock that has not done incredibly well in the past, I guess so far this year, whereas the market has recovered pretty significantly during that time. But it's the idea that it is a incredibly high dividend paying stock, or not incredibly high, it's a dividend yield of 2.37%, which is in line with what my portfolio is doing. But the big thing is that it has been a very high performing stock. Since 1995, it's up 14.37% on an annualized basis versus the S&P 500 at 9.29%. I buy into the stock because it has the reliability of being a power provider for Florida. They own Florida Power and Light, FPL, for people that know that. But they also are a large player in the renewable markets. So they're doing a lot of stuff with solar down in the southeast of the United States. All right, the second stock that I wanted to talk about is Home Depot. It is a stock, when you think of it, it's not super exciting. You think Home Depot and you're like, why would you want to buy into that? The whole point is we're trying not to buy exciting stocks. We want stocks that are going to slowly chug away without having to worry about it going down significantly. So boring stocks are the way to go in my opinion. And Home Depot is still down 5% in 2023. But the reason I'm buying it is because since 1995, it has outperformed the S&P 500 by a pretty significant margin, and actually Nextera Energy, which I was really surprised to hear. It has returned 15.14% on an annualized basis since 1995 versus the S&P 500 with that 9.29%, as I've already mentioned. It has a higher dividend yield than Nextera Energy at 2.79%, and adding it to my portfolio I think is fantastic because it gives some protection to whatever we see in the housing market. There's a lot of discussion based off of mortgage rates going above 7%, you have high interest, and so people are worried that the housing market is going to maybe not collapse, but really slow down. And Home Depot you can consider a recession-proof stock because when people are buying and the market's doing really well, you have a lot of new construction, and that's a lot of materials that are going to get bought from Home Depot. But when you have a recession, a lot of people tend to do renovations on their home on their own just because it is lower cost and it's something to do, and it feels like they are putting value back into their property even if they're not going to be able to sell anytime soon. So you've seen the results that it's had since 1995 when we had the financial crisis, which was based off of the bad mortgages, and so it has a history of doing incredibly well during this time. And looking at it in my portfolio, I think it's one of the smaller. It's 1.75% of my portfolio, so I really want to add to it now, especially when we have some uncertainty on what's going to happen in the housing market. So Home Depot is a stock that's not super exciting, but it excites me based off of its previous returns, its higher dividend yield than what I'm currently getting in my portfolio, and the fact that you could argue that it's a recession-proof stock. And I think that Home Depot is a natural part to put in my portfolio, and I want to make it a higher percentage weight than what it is currently, which is pretty much the same thing for Procter & Gamble, ticker symbol PG, which is up 3% year to date, but most of that is because they just posted their earnings report, where their stock price rose because of that, and they raised their guidance for 2023. When I talk about dividend stocks, I'm not super worried about the earnings reports, but when I hear a company raising their guidance for the next year, I feel pretty good about that. It has a dividend yield of 2.41%, and has had 11% annual return since 1995 versus that 9.29% of the S&P 500. So the stock that's outperformed the overall market, it gives some reliability with the type of products that they're putting out there, a lot of consumer discretionary, and a lot of stuff that people are going to be using no matter what the market conditions are. And so Procter & Gamble and Home Depot kind of go hand in hand in the recession-proof stocks that I'm looking to add. And also because it's a relatively small part of my portfolio. When you look at it, it is the third smallest at 1.14%. That and Home Depot can have a much higher weight, and that's why I'm looking to buy them right now. I have no reason to, ignore them. They're just weren't as exciting because, as I mentioned, you don't think of Home Depot and Procter & Gamble as exciting stocks. So when I was buying and dollar cost averaging, I wasn't buying into it. As a result, they've lagged behind a lot. So those are the three dividend stocks that I'm looking to buy in the upcoming weeks and months as the market kind of decides which direction it wants to go. These are stocks that have outperformed the S&P 500 since 1995, have a relatively solid dividend yield in the 2% range, which is pretty much on pace with what my portfolio is doing right now. And the bottom two, Home Depot and Procter & Gamble, are parts of my portfolio that have really lagged behind the other ones just because I've forgotten to add to them over the past year. So I want to get them more in line with some of the other stocks. And I'm very curious what dividend stocks you are looking to buy in the upcoming weeks and months in the comment section down below. What did you think about my portfolio, and what do you think about my strategy of buying stocks that really does not matter how they've done recently? I care about the long-term history of them. Let me know down below. My name is Andy. If you made it this far, please hit that like and subscribe button. We're trying to get to 10,000 subscribers eventually. I appreciate all the support, and I will see you in the next video. Thank you for watching.